Most people think a financial crisis begins with one dramatic event. One bank fails, one market cracks, one chart falls off a cliff, one name everyone recognizes suddenly becomes the villain. That is not how serious crises usually work. Serious crises begin in the quiet corners, in the places ordinary people do not watch. In balance sheets nobody reads, in private deals nobody understands, in risks that look manageable only because money was cheap, confidence was high, and nobody had yet been forced to ask what those assets were actually worth in a world without easy exits. That is where I want to begin. Not with a headline, with a structure, because if you misunderstand the structure, you will do what people always do. You will wait for the official moment. You will wait for the television language to become frightening enough. You will wait for the right person to say the right phrase so you can finally believe something serious is happening. By then, the repricing has usually already begun. By then, the easiest exits have already been taken by the people closest to the pipes. That is how the game works. The people nearest to the machinery smell the smoke first. The public usually waits for flame. If you want the mother line for everything I am about to tell you, here it is. Another financial crisis does not become dangerous because one market suddenly falls. It becomes dangerous when a hidden credit structure, an overvalued growth story, a public policy mistake, and a real world inflation shock begin reinforcing one another at the exact moment ordinary investors are being invited to absorb risks they do not understand. That is the line. Read it again, because once you understand that, you stop asking the wrong question. You stop asking whether there is officially a crisis yet. You stop asking whether the stock market can keep levitating for a little longer. You stop asking whether one hot sector can carry the whole economy if the rest of the structure is soft. You start asking the adult question, where is the hidden leverage who is being positioned to hold it, and what happens if liquidity gets tested all at once? That is the right question. That is the useful question. That is the question the public almost never asks until the people selling them the product have already reduced their own exposure. Now let me say something plainly. Wall Street has a memory problem, not an information problem, a discipline problem. That is what every cycle eventually reveals enough time passes after the last blow-up. Regulation shifts, old danger becomes yesterday. As story, new language arrives, new wrappers arrive, new distribution channels arrive. The same appetite for yield, fees, optimism, and innovation returns in a slightly different suit. That is how human finance works. We never really stop doing foolish things. We only rename them. That is why I do not care very much whether this next break looks exactly like 2008. It will not. No crisis repeats in costume, but the emotional architecture rhymes: opaque assets, yield hunger, mispriced risk, crowded optimism, political help for the wrong people at the wrong time, retail money arriving late. That is enough. That is more than enough. Now let me take you into the first mechanism. I call it the shadow loan machine. The source material centers this clearly. Private credit has become a roughly $3 trillion industry, built outside the most visible banking regulation after 2008, with risky lending pushed into a part of the system that offers little public transparency while still drawing in capital hungry for high returns. Fe filicite fe turn 54 file 0 fe, that is the shadow loan machine, and the name matters because a shadow machine can look efficient when conditions are favorable. Money comes in, loans go out, double-digit returns get advertised, private companies get financed, everyone involved tells a clean story. The banks are safer, the market is innovating, capital is being allocated. Good, that is how these things always sound in the expansion. But the real question is never how the machine looks during easy conditions. The real question is what happens when creditors need liquidity, borrowers get weaker, and nobody quite knows how much bad paper is hiding in the stack. That is where opacity stops being a feature and starts becoming a threat. Private credit became fashionable for a simple reason. Yield was attractive, traditional lending was constrained. Investors wanted more, managers wanted fees, borrowers wanted money. The structure expanded, fine. Expansion is not the proof of wisdom people think it is. A lot of bad structures expand beautifully, right until the moment they have to prove themselves under stress. That is exactly what the source material is warning about. It points to late 2020-25 and early 2026 bankruptcies in private credit, and to the language used by major Wall Street figures after those failures began showing up. It is not the isolated bankruptcy that matters most. It is what a few visible failures imply about the stuff that has not yet had to mark itself. Honestly, fe filicite fe turn 54 file 0 fe, that is the point when one cockroach appears. The concern is never the one cockroach, it is the kitchen. That is what mature capital understands. A bankruptcy in an opaque credit market is not merely a single error. It is a question mark attached to every position with similar assumptions. That is why these markets can remain calm for years and then reprice with unusual violence. Not because everyone learns something new overnight, because everyone is forced to admit at once that they never knew as much as they were pricing. That is the shadow loan machine. It creates the illusion of smooth yield while conditions are kind, then it punishes the people who confused opacity with safety. Now let me take you into the second mechanism. I call it the liquidity lie. This is where the whole thing stops being an abstract issue inside alternative finance and starts becoming a live stress event. The source material says that some of the largest asset managers, including BlackRock and others, have had to limit withdrawals from private credit vehicles because the capital was lent into assets that cannot be turned back into cash quickly when investors want out. It describes the resulting dynamic in exactly the right way. A kind of run on vehicles whose underlying holdings are not truly liquid. Fay file a site, Fay turn 54 file 0 Fay. That is the liquidity lie. A lot of modern finance depends on a comforting fiction that assets with long duration, weak secondary markets, and uncertain marks can be held inside structures promising enough access that investors feel calm right up until the moment they all ask for their money at the same time. That is not a small design flaw. It is often the whole vulnerability. If I own an illiquid loan wrapped in a liquid expectation, then I do not have safety. I have sequence risk. I have the right to feel fine only as long as not too many other people want the same door at the same time. That is not liquidity. That is conditional calm. And conditional calm is what breaks first when confidence slips. This is why I have always distrusted structures that offer the emotional experience of flexibility while owning assets that do not deserve that emotional promise. Because eventually the promise is tested. And when it is tested, managers do exactly what they were always going to do. They gate, they delay, they restrict. They remind investors that the underlying assets cannot be sold without damage, which means the investor discovers in the moment of fear that he did not own what he thought he owned. He owned access with conditions. That is the liquidity lie. And it can spread very quickly because once one door becomes sticky, everyone begins checking the hinges on every similar door. That is what contagion really is. Not magical transmission, suspicion about the convertibility of claims. Now let me say something harder. A lot of people think illiquidity is an issue only for professionals. Wrong. Illiquidity becomes a public issue the moment retirement money, pension money, and ordinary investors are invited into structures whose risks they did not underwrite and whose exits they do not control. That is when a Wall Street design problem becomes a household problem. That is exactly why the distribution question matters so much. Who is holding the bag if the product freezes? We will come back to that. Now let me take you into the third mechanism. I call it the bridge exposure. This is where people comfort themselves by saying private credit is not really the banks, so systemic risk should be limited. Too shallow, the source material explains why U.S. banks may have backed away from certain direct risky loans after 2008, but many of them continued financing the firms making those loans, leaving major banks exposed through nearly $300 billion of private credit linked lending, according to Moody, says cited in the file. Fay file a site, Fay turn 54 file 0 Fay. That matters enormously because it means the risk was not abolished. It was rerouted, and rerouted risk still counts. This is one of the oldest games in finance. The public hears less direct exposure and imagines safety. The structure hears different channel and quietly keeps the same economic dependency alive, one layer over. That is the bridge exposure. The bridge matters because it carries contagion without carrying obvious branding. The bank does not have to originate the ugliest loan to feel the pain of those loans going bad. It only has to finance the vehicle, warehouse the risk nearby, extend the wrong kind of liquidity, or sit one layer above a borrower who is suddenly weaker than he looked. That is how crises travel. Not always through the front door, sometimes through the corridor. This is why the source material is correct to focus not only on the private credit firms themselves, but also on the possibility that the weakness can spread outward into broader financial institutions if defaults deepen. Fay file a site, Fay turn 54 file 0 Fay. Exactly. A lot of people still reason about crises as though each silo stays in its lane. Energy stays in energy. Credit stays in credit. Technology stays in technology. A serious crisis begins when one weak structure starts touching another. That is what makes it systemic. A crack in one foundation is a problem. Cracks in multiple connected foundations become a repricing of trust. That is different. Trust is what keeps finance cheap. Once trust gets expensive, everything else follows. Now let me take you into the fourth mechanism. I call it the exit scam without the word scam. This is the part that should make ordinary people angrier than it does. The source material describes an August 2025 executive order presented as democratizing access to alternative assets for 401k investors. It argues that this move functionally widened the pool of less sophisticated capital available to absorb risks that more sophisticated investors were already trying to reduce exposure to as the private credit stress worsened. Fay file a site. Fay turn 54 file 0 Fay. That is the exit scam without the word scam. I am using careful language here because the core issue is not marketing style. It is transfer. Who gets the chance to lighten up first? Who gets handed the product next? Who gets told the thing is exciting, modern, diversified, democratized, sophisticated, and good for them right when the insiders are most eager to create a fresh buyer base? That is the question. And once you ask it, a lot of official language starts sounding less generous. A crisis often becomes truly dangerous, not when the first smart people see it, but when the structure finds a way to spread the exposure into pension systems, retirement plans, and retail channels under the banner of inclusion. That is one of the oldest games in the world. Call it democratization, call it access, call it modernization. The label does not matter. The direction matters. If the flow of bad or suspect risk is moving from concentrated professionals toward less sophisticated end holders, then someone is solving a distribution problem, not for the public, for the people already in the trade. That is what the public has to understand. Wall Street does not need you to be stupid. It only needs you to arrive late. And the source material is clearly arguing that ordinary savers and pension structures are being positioned as later holders of risks, whose underlying quality is already under question. Faithfulocite Fay Turn 54 File 0 Fay, that is the issue. Not fairness in the moral sense, timing in the structural sense. The late buyer is usually the vulnerable buyer. Now, let me take you into the fifth mechanism. I call it the AI revenue mirage. This is where the story gets even more dangerous because now the crisis risk is no longer confined to private credit. It starts touching the narrative holding up the broader market and much of the visible economy. The source material argues that AI is connected to this in two ways. First, because many private credit loans went to software companies now facing rising pressure and failure risk as AI changes their economics. Second, because the AI sector itself is described as a huge bubble built on firms investing in one another and carrying enormous obligations despite weak present profitability. It specifically points to OpenAI's low revenue and extraordinary obligations, and to the extraordinary concentration of market value in the so-called Magnificent Seven. Faithfulocite Fay Turn 54 File 0 Fay, the exact company-specific framing in the source, can be debated in detail. But the core structure it is pointing at is the right thing to examine. A market can become dangerously dependent on one narrative. In this case, the narrative is that AI not only represents the future, but can justify immense current valuations, immense current capital expenditure, and immense current optimism about national growth. Fine narratives can be partly true and still form a bubble. That is what people forget. A real technology does not protect you from an unreal multiple. A real breakthrough does not protect you from a fragile financing structure. A real future does not guarantee a sensible price in the present. That is the AI revenue mirage. When seven giant firms carry so much of the market's visible confidence, and when the economy's recent growth appears increasingly tied to information processing equipment and software spending, as the source says via Jason Furman's estimate, then the line between sector enthusiasm and macro dependency gets dangerously thin. Faithfulocite Fay Turn 54 File 0 Fay, that is the point. If the visible growth is too concentrated in one story, then the country can look stronger than the broad base actually is. The source material makes exactly this claim, that outside the AI heavy segment, much of the U.S. economy looks far weaker, even recessionary, and that aggregate GDP masks that weakness. Faithfulocite Fay Turn 54 File 0 Fay. This is where bubbles become politically useful. A narrow concentration of strength can flatter the national photograph. People say the market is strong. People say growth is positive. People say the future is being built. Maybe it is. Still, if the rest of the economy is weaker than the headline suggests, then the market is standing on a smaller platform than it appears to be. That is the AI revenue mirage. And if it cracks while private credit is already weakening and energy is already pushing inflation back upward, then you do not have one problem, you have synchronized fragility. That is much worse. Now let me take you into the sixth mechanism. I call it the valuation cliff. This is where the numbers stop being about taste and start becoming about proportion. The source material says the total U.S. stock market is valued at over 210% of GDP, exceeding both the 2007 peak and the dot-com era peak, while the top 7 American technology firms together are said to be worth more than entire major foreign equity markets. Faithfulocite Fay Turn 54 File 0 Fay, whether one prefers one valuation metric or another, the structural point remains powerful. A market heavily concentrated in a handful of giant names and trading at extreme levels relative to the underlying economy becomes less forgiving. That is what matters. You do not need a market to be fake for it to be vulnerable. It only needs to be priced for a future with very little room for disappointment. That is the valuation cliff. And cliffs are most dangerous not because they always collapse, but because once they do, there is not much slope to soften the move. A richly priced market can look indestructible right until the first serious doubt enters the story, then suddenly the same concentration that made it feel powerful makes it feel brittle. Too many portfolios depend on the same names, too many narratives depend on the same momentum. Too many retirement accounts depend on the same belief that this layer of the market will keep carrying everything else. That is a bad concentration. And when a cliff meets a liquidity problem underneath it, the repricing can become self-reinforcing. Prices fall, confidence drops, funds sell, collateral weakens, credit conditions tighten, weak companies lose funding. The growth story darkens, prices fall further. That is not an exotic theory. It is how cycles end. Now, let me take you into the seventh mechanism. I call it the real economy mask. This may be the part most people find hardest to accept because it offends the comforting language of national statistics. The source material says that more than 90% of U.S. GDP growth in the first half of 2025 came from information processing equipment and software investment, largely tied to AI, and that this created the appearance of broad growth while much of the country was already living in recessionary conditions. Fay-Felicite Fay-Turn 54 File 0 Fay, that is the real economy mask. A nation can look fine in the aggregate, while the distribution of that growth is far too narrow to protect the median household. If growth is concentrated in a small number of firms, sectors, and capital-intensive channels, then the ordinary worker does not necessarily feel it. The small business does not necessarily feel it. The indebted family does not necessarily feel it. This matters because markets trade the aggregate story while households live the distributed reality. Those are different experiences. And the gap between them is where political anger and financial fragility usually ferment together. If the stock market is telling one story and daily life is telling another, then confidence becomes unstable. People do not need a PhD to recognize that the official optimism does not match the lived squeeze. That is one reason late cycle environments can feel so strange. The indicators still glow. The people feel worn out. That is the real economy mask. The wrong conclusion is that the economy must be perfectly healthy because the market is high. The right conclusion is that a concentrated boom can hide a weak base for quite a while until something forces the mask to crack. That is what synchronized shocks do. Now let me take you into the eighth mechanism. I call it the energy fuse. This is where the file becomes much more serious than a normal Wall Street warning piece, because now the credit stress, valuation excess, and liquidity fragility are being joined by a real-world inflationary shock with geopolitical roots. The source material explicitly links the U.S.-Israeli war on Iran to a major oil shock, and then carries that through to inflation, food prices, fertilizer inputs, and recession risk. It presents this not as a side story, but as the additional force that could turn an already unstable system into a perfect storm. Fay-Felicite Fay-Turn 54 File 0 Fay, that is the energy fuse. And fuses matter because they do not need to be the whole bomb. They only need to connect the parts. Higher energy costs do not only hurt drivers, they hit transport, they hit food, they hit industrial cost structures, they hit inflation expectations, and once inflation expectations rise, the whole easy relief story for central banks becomes harder to sustain. That is where trouble compounds. A private credit problem on its own might have remained contained. An overvalued AI market on its own might have melted more slowly. A concentrated stock market on its own might have lived another year on optimism. Fine. But now add an energy shock, add food inflation pressure, add the return of policy difficulty, add the possibility that the cost of living rises right as the asset structures above the public begin wobbling. That is how isolated fragilities become a system. That is the energy fuse. And it matters because real-world price shocks are much less patient than financial narratives. Markets can tell themselves stories for a long time. A grocery bill does not. Now let me step back and show you the whole machine. An opaque credit market grows enormous in calm conditions. Liquidity inside it proves weaker than advertised. Large institutions are still tied to it through bridge exposures. Fresh retail and retirement capital are invited in under a language of access just as smarter money gets nervous. The broad market depends too much on one concentrated technology story. Valuations stand on a cliff. The real economy underneath is weaker than the aggregate numbers imply. Then an energy shock lands and pressures inflation. Food, financing, and confidence all at once. That is not a small correction story, that is a structure story, and once structures begin failing together, the public usually realizes late that the real danger was never one bad thing. It was the way several bad things could suddenly recognize one another. Now let me say something harder. The public still thinks crises announce themselves clearly. They usually do not. They whisper in specialist language first. Fund gates, spread widening, withdrawal limits, weird bankruptcies, valuation concentration, political distribution changes, energy repricing. Those are not random side plots. They are how the structure starts speaking before the headlines catch up. The source material is right to frame the current moment as a perfect storm, not because every line in it must happen in exactly the same way, but because the interaction of the pressures is the real story. Fay Philocite, Fay turn 54 file 0 Fay, that is the adult way to read it. Now, let me make the identity flip explicit. Most people think their job in a financial scare is to decide whether the market is about to crash tomorrow. That is too small. The real job is to understand whether the structure underneath the market is becoming easier or harder to trust, and whether the capital in your own life is positioned as an early seller, a late bag holder, or a patient buyer. That is the flip. A spectator asks whether the crisis is official. A steward of capital asks who is being moved into the risk and who is trying to move out of it. A spectator asks whether this looks like 2008. A steward asks which forms of opacity, concentration, and false liquidity now dominate this cycle. A spectator wants the right headline, a steward wants the right structure. Those are different minds. The market pays them very differently. Now let me bring the operating system together in plain language. First, respect opacity as a risk multiplier, not a side detail. Second, distrust any vehicle promising smoother liquidity than the underlying assets deserve. Third, watch how risk gets distributed to smaller and less sophisticated holders. Fourth, do not confuse a real technology with a safe valuation. Fifth, treat concentration in a few names as fragility disguised as strength. Sixth, remember that aggregate growth can hide a weak broad economy. Seventh, understand that real world shocks like energy can turn financial stress into systemic stress very quickly. That is the operating system, not panic, not denial clarity. Now let me put the blade into this as cleanly as I can. Another financial crisis is not dangerous because one market looks ugly. It becomes dangerous when private credit opacity, withdrawal pressure, giant valuation concentration, political distribution of bad risk, and an energy-driven inflation shock start reinforcing one another in a system that already depends too heavily on confidence. That is the real warning. And if you remember nothing else from what I said, remember this: by the time a financial crisis feels obvious to ordinary people, the people who design the products have usually already spent months figuring out who they want, holding the risk when the music stops. Make very sure it is not you.